The masses are currently drunk on dopamine, chasing artificial intelligence bubbles, and betting their livelihoods on lines of code that didn't exist 3 years ago. They are looking at the clouds. I am looking at the asphalt. While you were watching the Federal Reserve Chair speak, a boring, ugly gas station operator quietly increased its payout for the 16th time. Today, we are not discussing a stock. We are discussing a toll booth on the circulatory system of the American economy. If you want excitement, go to a casino. If you want to understand how wealth is actually preserved, sit down and listen. Let us begin with the first principle of our family's philosophy: inversion. Instead of asking how we can make money, we ask, how can we lose it? We look for the point of failure. In the current market hysteria, investors are flocking to technology. They believe in infinite growth, but technology is discretionary. If a recession hits, you do not buy the new phone. You do not upgrade the software. You cut the fat. Now, look at Global Partners LP. They move gasoline and diesel. They own the terminals. They own the gas stations. Ask yourself, what must happen for this business to go to zero? The answer is not a recession. The answer is not high interest rates. The answer is that the physical movement of goods across the United States must cease entirely. Trucks must stop moving food. Ambulances must stop moving patients. The economy must suffer total organ failure. If that happens, your Apple stock is worthless anyway. This is what I call the iron lung thesis. The economy may be sick. It may be sedated, but this company is the machine forcing air into its lungs. It cannot be turned off without killing the patient. The market penalizes this sector because it is low growth. They are fools. We do not seek growth, we seek inevitability, we seek the inelasticity moat. When the price of the product rises, demand stays flat because the user has no choice. That is power. While the venture capitalists chase the next unicorn, we own the road the unicorn must walk on to get to the slaughterhouse. Understand this distinction. Optical risk is when a chart looks ugly. Structural risk is when the product is unnecessary. We buy the former, we sell the latter. Now look at the balance sheet. Most of you would run away screaming. You see debt, you see leverage, you see a structure that looks antiquated. Good, this is exactly what we want. This is the rusty safe metaphor. To the average retail investor, and even to the algorithmic traders, this company looks terrible. It is not a shiny object. It is covered in the rust of heavy industry and capital expenditures because it looks ugly. It trades at a discount because it trades at a discount. The yield is artificially high. This is cognitive arbitrage. We are profiting from the inability of the market to distinguish between bad debt and structural leverage. Let us deconstruct the fear. The market fears that high interest rates will crush their margins. But we must look at the distribution coverage ratio. Is the cash flow sufficient to cover the payout? Yes, it is over 1.5 times covered. The high yield trap is a hallucination of the fearful. Furthermore, in an inflationary environment, debt is an asset. You borrow expensive dollars today and pay them back with cheaper, inflated dollars tomorrow. The market sees a 7% yield and thinks risk. I see a 7% rent payment for holding an essential asset while I wait for the world to come to its senses. We are paid to endure boredom. Most men cannot sit in a room alone and do nothing. They feel the need to trade, to tinker, to react to news. That is why they are poor. We buy the rusty safe not because we like rust, but because we know the combination to the lock is simply patience. Do not let the optics of a messy balance sheet distract you from the physics of cash flow. If the cash clears the bank, the chart does not matter. How does this end? This is the question you must ask before you enter any room, and certainly before you enter any trade. We do not hold this forever, hoping for a technological breakthrough. We are realists. The end game here is not innovation, it is consolidation. View this company not as a shareholder, but through the eyes of a private equity shark, a predator. What does the predator see? He sees a company with a strong moat but an inefficient capital structure. He sees debt that is expensive for them, but would be cheap for him. If a major energy giant or a sovereign wealth fund acquires this asset, they can refinance that debt instantly. They can cut the interest expense in half simply by signing a piece of paper. That immediate reduction in cost is value created out of thin air. That is the arbitrage. We are parking our capital here, collecting our rent, and waiting for the predator to arrive? This is time arbitrage. We are selling time to those who have none. When the consumer sentiment index hits maximum panic, when the news tells you the recession is here, that is when the weak hands fold. That is when the buy zone protocol activates. You do not buy when the sky is blue. You buy when the fog is so thick you cannot see the toll booth, but you know the cars must still pass through. Remember this, the market is a mechanism for transferring wealth from the impatient to the patient. We are the patient, we are looking at the asphalt while they look at the stars. Let them have their dreams. We will take their cash flow. Class dismissed.